All right, excellent. So this is Ineligible Ventures. A little bit of background on who we are to start things off. We're a seed stage venture fund focused on tech-enabled B2B products that can scale internationally. We're actually focused specifically on the Malaysian market. So this is where we're seeing a lot of opportunity, and hence why we're getting pretty actively involved in the ecosystem here. A little bit about myself. My name is Kevin Brocklin. I'm the managing partner. I'm also the general partner of the fund. My experience is primarily in fund management. I've managed hundreds of millions in assets, worked with some of the largest institutional investors, worked with hundreds of companies across continents, across countries, helping many of them to scale internationally. And so, the topic of today is business projections and looking at financial management for entrepreneurs. And I do have to say, this is a really big topic. So within the time that we have, we're really only going to be able to kind of scratch the surface. So in order to kind of set some of the expectations, I'm really looking at doing laying out some of the logic of how to go about setting up the business projections, how I see this as being an integral part. Not just in your ability to go out and raise funds, which matches with what the last couple of sessions have been about, but also there's a big usefulness into the way that you can look at your business, understand your business, and operate your business over time. So I think business projections are certainly a very, very important topic, and something that we may end up needing to look at running a couple of follow-ons to this in order to dive sufficiently. So let me kind of lay out how I see it fitting in the first place. When you create projections, it's not really you make it, you use it for its purpose of raising funds and you forget about it. It's not really intended to be that. What I like to refer to projections as is kind of like a living organism. And I mean that because it's constantly supposed to be evolving. And so it creates this cycle to where you're constantly going back and forth with it and updating it and so forth. And so the key pieces out of your projections is stepping back and having a view of what your strategy is. And for startups, it may not necessarily be extremely long-term. Long-term for a startup could be 2 to 3 years. It could be 5. It's generally relatively short because there's a lot of uncertainty. So you start with your strategy. And then from that, you're looking at, okay, well, what are my tactics? What are the actionable things that I'm going to be doing in order to execute the strategy? And so that's when you start being able to build out, when you understand what you're going to be doing, what tactics you're going to be taking, you understand the resources that you're going to end up using. You can understand kind of the outcome results of those actions, the kind of cause and effect. If I do this, then this will be the result. Generally, if I expend this cost, I'll get this sort of revenue back. And so there's a direct relationship there when you're going about and doing your projections. And we'll talk about some of the connections there later. And when you do that, you're setting kind of the goalposts, the mile markers, to use kind of a road analogy, of where along this path. So if you're setting a 3-year strategy, what is the goalpost that you're expecting to achieve after year 2, after year 1, after Q1, after Q2, and being able to set those up. And that's what ends up creating a well-rounded projection. But then once you create that projection, now you got to actually go out and execute on it. So you're getting actual results. And those actual results are translating into kind of the financial statements. You're getting the operating metrics, which we'll talk about that a little bit later of what operating metrics are. So you're getting this sort of data results coming back. And importantly for everyone, the ever important cash flow of what the inflow and outflow and what the remaining balance is. And so you get these results back, and the usefulness out of having a projection in the first place and then having actual results is that you go on to the next step and you look at the budget versus that actual, and then the ideal scenario is to where the way that you're creating your projections is in a similar or easy to compare format to how you're actually collecting actual results, so that when you're doing the comparison of this budget versus actual, it's easy to kind of match them up and look at them side by side and be able to see relatively easily, what went right, what went wrong, why is this not, why did I perform lower on this one, why did my costs go higher on this one, why was my conversion rate 15% instead of 20%. So it allows you to start having a little bit more visibility, and really when you start measuring and being able to look at it that way, you're going to be able to move into this next phase, which is being able to reset your expectations and revise and create updates around your assumptions. Because a lot of what you're doing by creating projections is you're creating like a hypothesis. You're saying, okay, well, if I do these sort of things, I'm expecting that the result will be this. But you're never going to end up being 100% on the mark with everything that you say. The reactions may end up being a little bit different. So by going through, you can revise and update your expectations, and that feeds yourself back in to say, okay, now I'm going to go back and update my projection model so that I can see, for example, how's my cash runway looked? Maybe I had a really terrible month, and now I got to look back and update my projections with the actual results and say, okay, do I still have a 12-month runway? Or maybe now it's 10 months. And now I need to figure out how can I make up some of this momentum. And by doing that, you can compare across, and it's that sort of cycle that I think everyone needs to start getting to. All right, so the agenda in regards to kind of laying this out, at least for the presentation part, is I'm going to do kind of an intro to unit economics. I'm going to talk a little bit about operating metrics, and then we're going to move into talking about the budgets. But I think it's really important straight away, right from the beginning, to understand that when it comes to finance, when it comes to your company, there's not really a one size fits all. I know there's this temptation to say, is there a template that I can plug my business into? And so, there's a template that could be modified to your particular circumstances. But by and large, I think a lot of companies have enough layers of uniqueness that you end up, if there is a template that exists, then you're going to end up having to do a decent amount of modifications. So what I'd like to get as kind of the takeaway after this is that you understand the logical flow around assumption setting first and foremost, because that's where the logical flow of being able to build out your projections is understanding the flow through of your assumptions in order to lead into what your revenue expectations are, what your cost expectations are. And honestly, if you can demonstrate those well, because again, this plan is your business projections are illustrating the tactics to achieve your strategy. And so from an investor standpoint, you're demonstrating your understanding of the strategy by illustrating a well thought out execution strategy that's depicted in the numbers, in the financial projections. And if you can do that well, you're increasing the level of confidence on behalf of that investor that you're going to be able to execute on this plan, because that's what you need. You're going to need to push them over the edge on saying, okay, why am I going to put my money at risk? If you can show that plan, that gives that extra layer of confidence that the money is going to be well spent and efficiently spent, and it's going to be able to achieve that sort of ROI that the investor is going to be looking for. Okay, cool. So I'm going to jump into this first section on unit economics. And first, I'm going to lead in with a quote that is fairly cliche, but I'm going to say it anyways. If you can't measure it, you can't improve it. And so a lot of what the business projections are, and what I was talking about with looking at budget versus actual on a going forward basis, is being able to measure and improve. That last stage of that cycle that I illustrated out of the revise and update on your projections, so that you can measure it and you can improve it. You can adjust the way that your actions are, because if you're not getting those sort of results and you don't have an expectation in the first place, you may not realize that perhaps you're going down the wrong path. And so it's quite important. So a brief intro into what unit economics are. And so essentially, when we're talking about unit economics, you're breaking down basically that top section of your income statement, your revenue and cost of goods sold, into a unit basis. And what that unit of measure is depends upon what your business actually is. So there's not like necessarily a standard of what do I mean by unit. The unit is kind of a measure that depends based upon the business. The customer could be a unit. If you have physical goods, it could be a unit of product. It could be a number of different things, but it's quite important in order to understand that. So you break it down into, for example, the revenue you receive, the cost of that revenue, and that then leads you into your contribution margin. So I'll do a simple example before jumping into this, since I talked about physical goods. If I go to some place and buy a cup of coffee, and that coffee costs me $2, that's the revenue that store is receiving for that unit of one cup of coffee. The cost for them likely is primarily associated with the beans, the water, the cup, etc., etc. So hypothetically, let's say that costs them 50 cents. Their contribution margin off of that is $1.50. So with that, somebody can easily look at it and say, okay, what's my fixed cost? So now if I'm making $1.50 off of every one of these, how many of them do I need to sell in order to cover the cost of this storefront? So the logic is along those sort of lines of being able to see ultimately, the revenue performance. You're looking at the margin basis to make sure that sometimes there's a reason to lose money on every sale. Sometimes there's very good reason, but you're looking at what the marginal profitability is on that, what your contribution margin is on per unit. And that helps you get into a whole lot of other types of analysis, which oftentimes leads into break-even analysis. It can lead into other sorts of analysis, but it's a great starting point. And if you understand your unit economics, you're positioned to have a much more informed conversation with an investor when you get to that point, when you're raising money. And also from an operational standpoint, it equips you to make better decisions operationally if you know your unit economics. So let's focus on the revenue side of it. As I said, you're breaking it down on a per unit basis. What that means, it really depends. So I've jotted down like a couple of examples here of what a unit economics could be. So for example, in that coffee, it's the average selling price. What's the average selling price of a coffee? Oftentimes, to extend that analogy, they may be selling, lattes, flat white, Tatetic, all of these different things could end up being sold. So they're likely not going to say, okay, it's selling price on every single one. Maybe they can go into that deep of analysis as well. But you may say, okay, out of all of the goods that I sell, the average unit sale is this. That's a type of way of going about it. It works within categories. Another way of looking at it is the ARPU. What's the average revenue per user? So if you're a SaaS company, for example, you can end up breaking it down on what's your revenue per user. What's that? I flashed up in the presentation last week. I showed the slide from an example slide from another company's pitch deck that showed their tiered packages. So that kind of then feeds into what's my average revenue per user. They could do an analysis on particular segments. Sometimes you discount things, sometimes you don't. So that's another way of looking at it. Another way is, well, maybe I'm actually just selling big corporate accounts and I'm not measuring it on the individual users. So to me, maybe it's more of average revenue per account. Or maybe I'm a marketing technology company, so I'm looking at serving agencies. And so my main measure is I'm looking at servicing accounts that I have with these agencies or something along those sort of lines. Another way, that a lot of people may end up being familiar with is looking at what the lifetime value of a customer is. I think a lot of times with this measure, especially when you're in the early days, lifetime value depends upon knowing how long of a life a customer has. And oftentimes when you're in the early days, you just don't know because you don't have enough data to substantiate what like a prolonged sustained churn rate or those sort of characteristics are, but it's still good to measure and understand. On the cost side of it, again, you're breaking it down in the same unit basis that you did the revenue. You need to match it so that it sticks. But like your customer acquisition costs, how much did it require you to capture that customer in the first place? Oftentimes, maybe that's marketing spend. Maybe it's something else. Your variable product costs, each unit, in the coffee example, the beans, the water, the cup itself, all of that, those are the variables that play into it, that each unit has its own. There's certainly circumstances where variable costs may end up decreasing with greater volume. But that's another thing that starts getting into a little bit more of a sophisticated analysis, but certainly something that you can still end up doing. What this doesn't include is it doesn't include like the fixed costs of like overhead and those sort of costs, because again, you're looking at for each kind of trying to get to the logic of for each individual unit that I sell additional, what's my profitability on that? That's kind of some of the logic that comes into it and why it feeds into building up towards a break-even analysis. And so the taking those two combined is the contribution margin, and this is essentially telling you the profitability of each of those sales as a measure of your viability. Again, sometimes there's a very valid reason to make a loss. It's a strategy that some companies take. But again, you're looking at your profitability, you're looking at measuring that relative to your overhead, relative to your tech spend, et cetera, so that you know the scale required to become profitable. The payback period. A lot of tech companies, it's very front loaded, where you're expending a lot of research and development, tech costs, the build costs, et cetera. So you can look at the unit economics and then see how long does it, if I know the scale required to get profitable, I can also see the payback period on the costs that were spent in order to develop it in the first place. And I can see the trend over time of what my contribution margin is. That all fits in with kind of the life cycle of a business and so forth. And understanding it can feed into a lot of the strategic decision making that companies are faced with. So let me shift now to operating metrics. And this is basically kind of like your guide to understanding the cause and effect in your business. Now, the point with operating metrics is to measure what matters. I'm sure people have probably heard the one metric that matters and other things that get tossed out like that. When you look at individual businesses, there's too many operating metrics for me to list everything. And honestly, every business is different. And the metrics that are relevant are going to be tied to what your actions and targets are. And so you need to be thoughtful about what you want to accomplish and what you're going to do in order to accomplish it. And that kind of sets what the most relevant operating metrics are going to be, because that's your linkage between action and target. That's the cause and effect. So that's really the usefulness out of these operating metrics. But the key with them is whatever you choose, it needs to be both, you need to be able to estimate it, something that you can actually look at and predict, or try to predict. I mean, you won't be, I've never seen anybody be 100% accurate ever in my life with any projection. But you need to be able to try to estimate it. And you also need to be able to monitor it, because ultimately you want to be able to compare what you thought would happen with what actually did happen, so that you can change your actions to achieve a target, because you're learning over time the cause and effect of your actions by looking at that operating metric and understanding the linkage to the ultimate outcome. So I am going to list some examples, but again, these are just a small portion of them. So like when we look at kind of this column here of the acquisition, activation sort of segment. So when you have a lead pool of potential clients, you're undertaking some type of effort in order to get them to do some sort of action. So for example, if I'm trying to get them to sign up, I'm a freemium service. And my first step of acquisition is getting them to sign up in the first place. My main goal, I think I have a great product-led growth strategy. I just need somebody to sign up in the first place. If they sign up, they're going to love it and they're going to spend money. They're going to upgrade. So I'm really focused on just getting those signups. I need people signing up. So I'm looking at that. I'm looking at perhaps my activation rate. Maybe I've defined at some point in time, maybe they have to fill out their profile. And once they fill out their profile, I consider it activated. So it's not just a matter of, hey, somebody downloaded my app or signed up, but now they've actually activated. They've taken that first call to action, whatever it is, and now they've activated. Another one, this third one's a little bit tough to measure, to be perfectly honest with you, but it's part of the product flow, is the time to first, and in brackets, key action, whatever that key action is. And so generally people refer to it, try and isolate, time to first value. That how long does it take for somebody in a freemium model, for example, how long does it take somebody in order to where they should realize sufficient amount of value of the product in order to then be at the point where they should be making the purchase decision? If I'm measuring that and I'm looking at my data and saying, okay, within 30-day trial period, that should end up hitting. But I think the time to first action is really 2 weeks. So I'm giving them a little bit more time than that. So I start measuring it along, and there's different tactics, but that's sort of, it's giving me insight into that cause and effect. Am I delivering the value quickly enough? Are they realizing it? Maybe I need to change the feature profile or something like that. Maybe I need to do some other activities, a tutorial when they sign up so that they realize the features, etc. Customer acquisition costs, when you look at it on a unit basis, that's giving you the insight on like the efficiency of your ad spend or the efficiency of your lead gen, whatever the activities that you're taking. All right, so that's it. That's the acquisition side. So there's a bunch that are probably relevant to your, I didn't even talk about conversions. There's a number of different ones, converting through the funnel, stage to stage. There's a bunch of different ones. Looking at like the customer and the revenue side. So that's, sorry, now I do have conversion, right? I'm jumping ahead. So like converting customers over, turning a customer into revenue. If I'm looking at my, and I know funnels are easy to measure, even though a lot of people are now thinking flywheels. It's easy to talk in terms of this as far as kind of intro to the concept. When I'm looking at working down that funnel, there's a conversion rate. Not everyone makes the purchase decision. Some percentage of that is, but if I'm measuring and tracking that, I can take different actions in how I'm approaching my customers during that funnel stage, and I can see the impact on my conversion rate. Similarly, if I have like a customer success team, I can take certain types of actions and I can have an impact on the churn rate. The churn rate being how many people stop renewing. You could conversely look at the renewal rate. Getting back to some of these same unit economics measures are also good metrics to look at. The average revenue per user or average revenue per account, because you can look at these and you can say, okay, a big thing in SaaS and similar sorts of companies is being able to see growth in your average revenue per user. So if I have a product-led growth strategy, my key is to have a positive net dollar retention. And what that metric means, because that may be unfamiliar to some people, is that it's a kind of a measure of what your organic growth is, not counting new signups. If I look at my customers today, I'm going to subtract off the ones that churn. I'm going to add up any of the expansion revenue for the upsells or cross sells, but then I have to subtract for anybody that downgraded package. And if that's above 1 as a ratio, then I have organic growth to where I could grow at a certain level without even adding in more customers. So there's a bunch of cool ratios to where you can break them down into subcomponents as well. But the key point here is that all of these have linkages to your actions and are giving you insights into what the results are. And so, for example, if you're looking at ARPU, if you increase your average revenue per user without adding any more new customers, you can increase your revenue the next month just by increasing that. Not even getting into the adding new customer side. So, there's the linkage to the cause and effect is the point here, and leveraging these when you're building out your financial projections. All right, so turning actions into budgets. This is really what it all boils down to. You're trying to work from your strategy. So the kind of the flow process here is you're trying to figure out your strategy. You're trying to define where is it that you want to be. And as I said earlier, this is for startups, it's generally relatively short term. You're really talking about 2 or 3 year time horizon as far as where do you want to be. And then you're breaking that down into smaller chunks. And then that flows into figuring out what are the tactics, what do you need to actually do in order to execute on that? What are the actions that you're going to take? And then once you start going through all of that's basically the building blocks of translating that into the number side, which is the cost of the actions and the revenue that will result from those tactics. So flowing down, what's your long-term vision? Are you creating a market? Are you disrupting a market? What is the long-term vision for where you are going? Putting that sort of North Star as like the end point of your roadmap. And then you create the roadmap of the tactics and say from point A to B, point B is not always a straight line. So sometimes you have to create like building blocks in order to get to there. So you need to be able to look at it and say, okay, if I want to be here in 3 years, what do I need to do today to start building up to that point? And the annual budget, year one is the first stepping stone into that roadmap. So you establish, the level of detail that you go into is significantly greater for that first year. And then oftentimes, unless you have a whole lot of clarity on a longer term, you basically kind of run it out onto a longer time period. So when you have those components, now you're defining, what is it that you're specifically doing. The initiatives. I need to launch XYZ product. I need to reach these numbers of customers. You keep it simple and definable and with a connection to the target. And it's good, and I'll comment and said at the end, is attaching operating metrics. When you have those initiatives, underneath those initiatives have different sorts of actionable items that you will do in order to accomplish those initiatives. So think of this as like, when I say initiatives, let's translate that and perhaps change it up and say, okay, I set an annual budget. This is my target for the year. This is what I want to end the year at. What do I need to do in what's my Q1 initiative? What's my Q2 initiative, Q3, Q4? And then within those, maybe I'm breaking it down to weekly or monthly within it of what are the actions that I'm taking on a regular basis, day in and day out. This is when it gets to what is my team doing or needing to do in order to achieve these initiatives. And again, when you're setting this out, it's good to be clear on it, and it's good to try and draw direct connections between cause and effect, action and result. So if I'm saying I need to add 1,000 new customers, I have to think to myself, what does that mean from a pipeline standpoint? What's my funnel look like? How many salespeople do I actually need? How many sales calls do they need to go on? How many product demos are they having to do? So that's kind of the logic of trying to think through. When I'm setting these targets, I have to be able to think through on the specific actions required in order to achieve them, so that I can understand what the costs are, what the resources are that are going to be required in order to accomplish the initiative, in order to provide, in order to do the specific action, right? And so the operating metrics, bringing this back into it, these are your measuring blocks. This is what you can use in order to track each action's results and build towards your target. It's what kind of, again, I'm overusing this perhaps, but it's the cause and effect. It's really important to be able to understand the critical operating metrics, so that you can have that understanding of the connection between actions and results. Cool. So how this flows down, and I'm putting this in slightly different words, is that, again, you're setting that long-term target, right? So this is kind of your North Star. That's your, in 2 or 3 years, this is where I'm going to be at. And then that target ends up getting broken down into shorter intervals. Frequently, you go from a 3-year to trying to break down the targets into annual. And then for the current year, you're really delving into a lot more detail. So you're breaking that down into quarters. And oftentimes, you're actually breaking it down into months. And then for that, you're creating your detailed action plan in order to achieve those quarterly objectives. Understanding, by the way, that I've seen a lot of people just say, okay, I'm going to get 1,000 new clients. So there's 4 quarters. I'm going to get 250 clients each of the quarters. And honestly, it generally doesn't flow that way in reality. It's kind of an easy way for somebody to create the estimate in reality, because the actuality, especially for early stage companies that are in their growth stage, is that you may only get 50 customers in Q1. And then all of a sudden you start scaling up and getting more visibility and notoriety. And so then you grab 250. So now you got 300 total, but then Q3 ends up doing really well and you end up getting another 300. So now I've got 600, and then I do even better in Q4 and I lock down the remaining 400. So it kind of scales up over time. So I think it's important in order to look at it in a little bit more of that sort of how things will scale up, because again, it relates back to what point in the year do I need to make the hire decision so that I can start planning in advance and understanding when do I need to hire an additional salesperson so that I can do these extra sales calls. Okay, so that's the action plan, and then that boils down into looking at what the metrics of success are that you're assigning at periodic intervals. Because again, it's useful in order to create this projection because it gives you that sort of frame of thought of what do I need to do. But when you're defining out the metrics of success using these operating metrics and saying, okay, this is what success means, that then translates in your ability to monitor it over time and look at it and say, okay, did I achieve it? And if you set the metric well, it's a metric that tells you the cause and effect where now you can say, okay, well, I know that I've been doing this and I can adjust and revise my approach. So maybe my sales strategy is not what it should be. So now I'm going to go back and modify my approach. Maybe my promotional materials, maybe it's some of the product features. When you set the metrics of success well, it gives you a lot of good insight into understanding whether or not you're on the correct path. Cool. So what we're going to do now is we're going to actually do something quite interesting. So Jeff has been nice enough in order to volunteer like he did on Tuesday. So I'm going to do kind of similar to what I did with his pitch deck. I'm just going to review his financial model and think out loud and comment on it. Then we're going to pull him up, have a quick chat about it. We're going to probably have maybe 10 minutes at the end in order to open it up to everyone in the audience. So this part is kind of interesting, I think, to get some more variety. So if anyone's interested in trying to get some insight on how I would view some of the logical flow on your assumptions in order to build that segment of your projections, what sort of operating metrics, and a lot of it's going to be thinking off the top of my head, but if you want to just kind of hear me think it out with you, start putting into the chat right now what it is that you sell, what your sales strategy currently looks like, and any relevant details on what your variable costs side ends up looking like. And we'll select a few of those and just kind of talk through some of the logical flow. And who knows, maybe I'll open up a blank tab in Excel and illustrate as opposed to just speaking it out. So I'm going to stop sharing this and I am going to open up in Excel now. All right, cool. So this is the projection model from Jeff. So I'm just going to kind of react out loud to it as I go through this. Right. So let's see, these are the metrics: collection amount broken out quarterly, and then what's the percent fee? So this is the fees that they would generate. So now he's looking at how many demo sessions he would end up needing to do in order to get the traction, how many operators that he would be able to sign up out of that. I see over here that he's got the conversion ratio. So I think from right off the bat here, chances are what I would end up doing is probably directly linking this, adding a row in here, and then just saying it's 15.12%, and then simply linking it directly in. So maybe I'm expecting that as I grow, my conversion rate is going to improve over time. Maybe if I do that, and now I'm messing with his spreadsheet. Maybe now it starts looking a little bit different because now I end up saying 20% or 25% because I'm starting to get better at it. People are understanding the product a little bit better. We're moving along. We're doing quite well. But I think pulling it into the columns for this makes it a little bit clearer for me, the reader, of being able to see the direct connection. And I do have to warn you, I'm a numbers person, so I kind of zoom in on a lot of these formulas. And likely here as well, I'd love to see the connection between the number of the sign-up operators, what the connection is between these operators and what the rental collection is. We have a average here, but I'd love to see that incorporated here to where now I know what's the number of units that are building into this collection amount and how he's actually translating these operators into average number of units per operator. That starts building it through. Maybe I change a sales tactic later on and going after smaller operators. That's going to completely change the fundamentals of my model. It may end up changing my unit economics, but if I break it down that way on this spreadsheet, it'll make it a lot easier for me to be able to zero in on those types of more minute details that are going to be useful in my strategy execution. And it also conveys the message to the investor. All right, so cool. These are e-booking for property agents. This is kind of looking like either a number of, or I'm not 100% sure whether or not this is a revenue number or whether or not this is a revenue number. So I'm a little bit off on the connection between these. Maybe this is, no, it can't be monthly because that would add up to a different number. So not 100% clear on the bottom part here. Cool. So I'm going to jump in. So I mean, organization-wise, I mean, it's structured well. He's got it clearly labeled. There's a good design aspect to it. He's got it separated between product 1 and product 2 here. The price is separated out. I think a similar aspect to the comment. I think it would be useful in order to break out some detail on what the funnel looks like. So that you can see that lead gen funneling down. It might actually be useful to simply combine this metrics into the same, to where you have one tab that you can label assumptions, and this is your assumption tab. I think that's kind of a design flair that a lot of people like to do is have one isolated tab that houses all of the assumptions so that it's clear to any third party that's looking at it of where to find any of the key things that are driving it. So yeah, number of new subscriptions. Yeah, I think that's the big key thing here, is just being able to understand the funnel of where these new subscribers get added onto. We have existing property agencies that are 500 times 10. And so that's where the 5,000 is coming from. I think with here, we probably want to look at what a churn is. We may not have sufficient enough information. There might be really low churn, but we should end up trying to break this out a little bit and have some sort of estimation on what churn over time could end up looking like. Because maybe property agency ends up changing hands. When you're looking at those sort of factors, I think that would be a really useful component here. Similar to what I said on the metrics, just kind of coming out to what's a little bit of the unit background on where this collection amount is coming from. So kind of, again, looking at some of the funnel on how you're going to scale this up, how you're adding new operators, the units per, what that funnel looks like. If maybe you want to back it all the way up into looking at what your conversion base is, so that you can have some more insights into what your sales resources required, what your marketing and sales resources are going to be required in order to hit those numbers. It also can right size it along with looking at what population size of room operators are relative to your acquisition rate of them. Maybe not for the model that you share with an investor, but maybe within your own files, you could even look at it in cohorts. Large operators, mid-size operators, small operators. So there's a number of interesting things that you could do with it in order to kind of get some additional detail in looking at that funnel and how you can build up to these rent numbers and acquire that revenue. And then these look like new products that are going to launch over the course of time. So I think this is another thing to where, my guess from the way that I'm looking at this is that a lot of this is just add-on sales to the existing operators that are within this product. So this looks to me like an upsell. And so, I talked about net revenue retention earlier. So I'd probably look at this in a similar sort of basis and try and think of it in terms along those sort of lines of how many of these operators that I currently have do I think I'm going to be able to upsell on getting this $50 per tenancy, the e-tenancy. How many of them do I think I'm going to be able to upsell on these IoT devices as well? So I think those are the key things. Probably coming off of that, the cost side of it, to get into some of the other side of the equation on the unit economics would just be to try and pull out some by expanding on that sales funnel. You'll be able to extract more details on, like you had here, number of salespeople, so that you can kind of start getting an understanding of what your customer acquisition cost is. It'll start giving you a bit more insights into your unit economics. But other than that, I mean, there's a few additions. But again, when you're early stage, you don't want to go crazy with trying to do a ton of detail. The main thing is figuring out what the useful metrics are. So for an early stage, you're wanting to add new accounts. So inevitably, it's going to be looking at the sales funnel. So breaking that out is going to be something that's important because you're going to end up holding accountable whoever in your team is responsible for the sales function or the marketing function when you're looking at just lead gen. Cool, and then it works into the P&L. So I think looking at this, I see a lot of these numbers are hard coded. So I would say turn this into just a whole bunch of formulas that link back to the assumption tab so that when I pull it up and look at it, I can actually match the figures and simply look at the formulas, because I'll go like this. I'll scroll down, look at the formulas, and then I'll start going across and making sure that they're just consistent. If I see that all the formulas are consistent, then, most of my time is just like, all right, margins, profitability, are any of these fluctuating a whole lot, that sort of stuff. Then I get into cash flow. This should also be linked up to either the P&L or the assumption tab. And so it looks like there's some funding expectations. So I think this is good. Most people don't need to create a balance sheet or anything like that. So I think this is good. My main overarching comment, I think, is just expanding the assumptions here, incorporating some of the funnel into it, and isolating out some of the individual metrics, especially when you start getting into these upsells. So considering where the revenue's at, I think, by and large, this is going to be your priority at this point is going to be looking at a lot of those funnel metrics on client acquisition. Later iterations of this, it can evolve and start getting more into product focused and average revenue per user, per account, per operator, those sort of metrics. I think that's the key points from my viewpoint. So I think that's it from that. So I'm curious, Jeff, if you wanna unmute and let me know if there's anything that I said that took you by surprise.
Hi, Kevin. Thanks for the comment. You're sharing, then only we realized that we didn't track much about this average revenue per customers. So I think we have to do more tracking on that part so that only we can be accurately know about this conversion rate, churn rate, retention, and so on. Then yeah, and then I really appreciate about the easier for people to see and to read how that number get it from, so that they don't have to look into too much of details. It will save their time when they read it through. Yeah, thanks for that advice.